where Leo actually left, that actually there's a context in which we all operate. And let's move on to the next slide. So this context is, and this is really my learning of last 2 decades in this industry, that what is it that drives our business? You and I have interacted, for several years, and but I just thought, let me just put it all together, so that we can, relate better, and then I can, you'll also see the sense in which I talk in my next few slides. First of all is the market, and markets, as last 5 years were very tough, and suddenly in 6 months, we have forgotten those days. We are all very optimistic. We are now saying that, okay, next few years, decades, will be fantastic. Let me tell you one thing, that markets are always volatile. Markets always surprise. And if we are unable to adjust to those markets, I think our businesses cannot prosper, either as manufacturers or distributors. So yes, I'm very bullish today on the markets, but I think that's something which we must always keep at the back of our mind. The second thing which I believe drives this industry is regulation. And again, I find that we have forgotten all that very soon. There was a time not too long ago where we used to dread the Friday, because every Friday there'll be a new guideline from SEBI, and we had to really adjust to it. And today we find, in fact, this is the reverse, where I think we don't have a list anymore to give to our regulator on what more is required, and the regulator has been very supportive. But mind you, there are still a lot of work to be done on the regulatory front. I think the questions of whether you are an advisor, a distributor, are you going to buy it on your own? There are many of those questions which are still been unanswered. Who will regulate the distributors, for example? I think is a big question. There is a lot of discussion on this subject. There are a lot of, things happening in that space, but beware that this is something which is going to continue, and it's a very important piece that needs to be addressed. The third is taxation. And obviously, we were a bit disappointed with the taxation changes on the debt side. But I do believe that the taxation regime for mutual funds, has been just amazing. Especially when you look at equity funds, you find that you hold it for a year and you get tax-free returns. So it's very easy, to really go and sell a product which has all these tax advantages. What disappoints me is that when we had the tax arbitrage in our favor on the debt side, as an industry, we just did not leverage that enough, to create the retail business, which could also have been done. Those taxation changes have now gone, but I'm sure those opportunities will still remain. The government is very conscious of the fact that, they want to promote long-term savings in the country. So products like pension, the benefits on Section 80C, I do believe that at least we are in a regime where taxation will always be favorable. So it all helps our business. As we want to do our business, if there are more tax ops, it's much easier to sell any product, and that drives our business. On a day-to-day basis, we just take it for granted, but believe me, that's something which we must always be aware of and leverage it to our advantage as we go ahead. Fourth factor, which is household savings, and I don't know how many of you have been following this, but savings rate in India is one of the highest in the world. But over the last 4 years, the savings rate has dipped from close to about, household savings is here what I'm talking about. Overall savings rate are close to about 38%, 36% in India. But household savings, which were close to about 24% of our GDP, have dipped down a little bit to about 22%. But what has really hit our business the most over the last few years is that when a household is saving 22%, the household was investing this money in gold and real estate, right? So my view is that, with where property prices are and where gold is, I think we'll all be surprised that how this money now starts moving back to financial assets. I think the government has made it very clear that they want to encourage households to save, in financial assets rather than, buy physical assets. So I do believe that's another area which is again going to be very favorable for all of us. Urbanization, and this is a question a lot of people ask me, that why do you think urbanization is a key driver? I think urbanization enables a lot of individuals to experience a lot of new infrastructure, new technology in a far easier manner. So I think as India urbanizes, we're going to see a tremendous growth in a lot of our businesses, and I think it will impact mutual fund businesses as well, because urban households typically have better bank penetration rates, more access to savvier advisors like all of you, and hence the business just grows on that basis. So I do believe that's another great pointer for our future. And life expectancy. All of us are going to live longer. I'll just take one slide. Let's move to the next slide. that I've just captured those macros here. I can share data on all the points which I've discussed here. But as you can see here, we are extremely bullish on the markets. So if I take a short-term view, the next 3-year views, I believe that whatever you touch will probably be gold. All of us have come to you saying, equity, it's a great time to buy. So all of us are buying equities. But look at it, if interest rate starts to go down, debt investments will also be very, positive for all of us. And my view is that any one of us can create any product, and whatever you buy, chances are you'll be very successful. And the reason is that as interest rates come down, I can come and sell you a credit story. That look, small and medium companies will do well. They have access to lower rates. So, and hence, why don't you buy papers which will, which will also increase in value as the ratings change and become more positive. I can also come and tell you that, okay, why don't you buy hybrid products? I can come and sell you duration products, because if interest rates are going down, maybe it's a great time to buy long term. Now, in my career of last 2 decades, very rarely I have been at a point in time, where every investment category looks as attractive as it looks today. And I think it's for all of us in the room here to take advantage of this situation, because we don't know how long this situation will last. And if we do that, I think it's going to be a big thing for our businesses. Let's move on to the next slide. So now let's more focus on something micro. We saw the macro drivers. So all I can say is, since cricket is today the theme in a way, we are on a great batting wicket. It's not England, it's batting in India. So, it's a dead surface. If you want to score 500 runs, probably this is the time to do it. I don't think so you're going to get these opportunities for too long. I'm not saying that hence, we forget all the risk factors. There are a couple of them, inflation in particular, and the US situation from an external side. But overall, I would still say that the environment is great for us. And in the short run, the next 2-3 years probably, could be a great start for all of us to come back very strongly into the market. So let's start from you now, in terms of what I believe are the drivers for each one of us in our business as an independent financial advisor. Next slide, please. So obviously we have to drive ourselves. Nobody is going to come from outside. We can have as many speakers here, but if at the end of the day, all of you are not motivated enough, there's not enough ambition, right, nothing is going to change. So my view is that all of you have taken a lot of effort to come in here. And at least I don't take this for granted, because in my whole career, I've come across maybe a few thousands of financial advisors. So my view has been that it's very easy to be an advisor. All you have to do is clear 1 or 2 exams, and you are in business. You don't need any capital to get into our business. Then to be a successful advisor, maybe that is also not difficult. So you'll get a few customers, and you'll build some assets, you'll sell some insurance, you may sell some mortgages, and you'll be in business. So that also is, and you can run your household. I meet a lot of individuals, who are doing that, and they are reasonably successful. So you can earn a living by doing that. But if you really want to become a great advisor, right, and you want to be in the top 2-3%, all of you can look at data on MDRT, that how many people start off as being insurance advisors and how many eventually become MDRT qualifiers. Leave alone the MDRT space or insurance, look at our own industry. We've been in business now for over 50 years. Maybe the new industry started a decade and a half back. This industry has just produced, 3,000 advisors with more than 10 crores of assets, right? So you can imagine, we have 48,000, KYD holders, but the reality is that I don't see a lot of us as ambitious, and I think ambition is a very important point which I would like to highlight. That's the starting point of our business. Let's go to the next slide. And I think Leo also mentioned, and we saw the story of the eagle here, why should we take a long-term view of the business? Right, and I've put a number here saying that leave a legacy and be a part of the 1,000 crore club. Right? Why is it that all of in this room should aspire to raise 1,000 crores? And let me just share with you a very simple example that, this business is such that it takes a lot of hard work to build initially. And what I have found is that after all of us have done our hard work, we don't take it to the next stage. We don't really take it for the next generation. So at least when I start dealing all of you here, my view is that you're going to be around for the next 30, 40, 50 years. And maybe it will change. You'll pass a legacy to someone. And I can give you a simple example, of how many customers do you think are required to do 1,000 crores of assets? right? I'll give you a simple example. My son, a couple of years back, he became 18 years old, and I had done an SIP way back in 96 in a fund called Templeton India Growth Fund, and I had 10 lakh rupees with that fund. So I gave it to my son and said, look, at 18, I have to make a choice. Either I trust you, right? I give you this money, or I just take it, because once you become a major, you will have right to this money. So I also told him that, by the way, you can't get 10 lakhs without listening a lecture from me for next half an hour or so. And he agreed to that. So he said, okay, 10 lakhs mil raha hai, to aadha ghanta kya farak padega? And all I told him is very simple, that look, if you could just leave this money aside for the next 40 years, right? And if he could achieve doubling of his money every 4 years, right? I see a lot of mutual funds today which say that they have delivered 20, 21% returns over the last 10, 15 years. So doubling of money requires a 19% CAGR, right? So now you can do the maths. You have 10 time periods of 4 years each. So 2 raised to 10 is 1,024. And that 10 lakhs becomes 100 crores. So which means that if you have just 10 customers, right, you can achieve this 1,000 crore club, provided you have a long-term view of the business. But if your view of the business is, oh, I only want to survive for today, and how many of us cannot get 10 customers, who will hopefully stay put that long? Now, obviously, I have been in sales, so of course, we can give the story. Some people will listen to it. So maybe you need 50 customers, of which 10 customers will stay with you and grow to that 100 crores. So when I meet young people today, and I ask them for a number, how much assets would they like to have in their lifetime, I don't get answers of our time when I used to say, "Arey, 10 lakh rupees ho gaya to retire ho jayenge hum." Right? Today the answers are close to 50, 100 crores each. So then again, it's our limiting sense. When we fail to see the long term and are able to really sell that concept to somebody else. So of course there are different segments. I just talked about a segment, a young segment. If they can put some money aside away, this 1,000 crore club is not a big thing for any one of us to achieve. Let's go to the next slide, please. Now, this is very important. Maybe I've been in a corporate world, so I feel that when I meet independent advisors, I ask them this question: why did they become advisors? And many a times they say, sir, I need free time. I should work at my own pace, and that's fine. But the reality is, if you're doing this business and want to do it seriously, you will have to build annual plans. I've asked this question to even the very successful advisors. The difference has been that they are very clear that what is it that they'll accomplish each year. Now, you cannot do everything in the same year. For example, I put some examples here that I'll add new customer segments, right? So now you may be dealing with maybe only retirees, or you're dealing with only professionals. Now, you want to add an SME to your list. You want to add some other segment to your list. It's not going to happen overnight. Because as you meet those customers, they have a different set of requirements, and hence it's not easy for the advisor to adapt and present himself in the new form for this new customer. Similarly, you want to add different product categories, right? Why should you only sell mutual funds? You should sell other product categories as well. And I'll tell you why I'm telling you this, because it actually will aid the business of mutual funds if you also add different categories to your list. Acquiring new customers, or just building higher margins. At times you're saying, I'll gather assets. At times you will say, I want to hire, get a higher margin. Or improve your service delivery, right? So we are all here because we believe in a technology platform. We believe we want to relate to a savvier investor base and give them the best of reports, right, which the fundu.com is doing. So I think those are the kind of thoughts which are very, very important. Let's go to the next slide, please. Build a diversified business. And the charts here are actually showing penetration rates across insurance, mortgages, and mutual funds. And India is really a very under-penetrated market. Now, the reason I always insist that you must look at other product categories is that is the source of getting new customers. So when I meet various banks, I find that they will sell a mortgage, and then they'll cross-sell an investment product. So the acquisition of customers can happen through better training as well, like referral training and many other things. But I feel the best way to acquire is really to go and sell new product segments and build a diversifying business. Also then reduces the risk of your business on one product category. So tomorrow if markets crash, you don't have to worry. You say, okay, I will sell mortgages, I'll sell insurance, and I can still lead my household. And you'll survive for the next 30, 40 years if you accomplish that. So building a diversified business is fairly critical in my view. Let's move to the next slide. Acquiring new customers in India, and this is a very old McKinsey study I have put here, where it just shows that how India's middle class will become some 20 times bigger than what it is today over the next decade or so. This is a 2007 study available on the web. You can have a look at it. I think it's still very relevant when it was done. And why new customers? The problem is that once you have invested your money, there's only one thing you can do, redeem it. And once you redeem it, you lose your income, you lose your assets, and you have to replace it. Now, you can replace it with the same customer, or you can replace it by getting new customers all the time. But if your business has stopped acquiring new customers, then you are in trouble. And I've asked this question to several people that, okay, by the way, how many customers did you acquire last year? And I generally don't get an answer. They said, aaye honge thode bahut. Right? So, which I think is again very crucial for building a very important business. And this is a paradigm shift you must have. You must have a method of acquiring new customers all the time if you want to stay relevant and grow bigger in the industry. Let's move to the next slide, please. Building your organization, right? And so my view is very simple, that any advisor who at least needs a runner boy and somebody to run the back office, that's the least. But yeah, if you can build a sales team of your own, and we know of many successful advisors that do that brilliantly. I gave you an example that you should sell various products. Now, my experience has been that all of us become good at one product category, and that will always dominate. So for example, if I were to quit and start my own business as an IFA, chances are I'll only sell mutual funds. But I know my customers need mortgages, they need insurance. So maybe I can take that business and give it to somebody else. So you don't have to do it yourself. Or maybe I can hire a specialist in my team who will just do that. So I don't have to now learn the ropes of insurance, figure out how medical insurance is settled, whether the hospital settles it on time or not. I can use somebody else who will be good at it and who will do that for us. So I think this is one area where many IFAs have struggled, and that's why they don't scale up, because they are unable to build a team and unable to really delegate some of the work that they do on a day-to-day basis. And they remain small because they are just unable to go to the next level because of this reason. So building an organization is very important. Next slide, please. And leveraging technology, I think that's the only way you can get efficient is if you have technology. And as much technology can do in terms of, you can adopt, you'll have more error-free transactions, you'll have more simpler life. Idea is you go and then focus only on sales, and technology takes care of execution. I think India is still a little away from this, but I do believe the next few years, as an industry, we need to figure out a solution which makes life simpler and which does not, it's not around that the IFAs lose business and because technology is there. It's about how to enable an IFA do that business in a far superior manner. So I think these are the key points which I want to mention. Just a couple of concluding comments. Let's go on to the next slide. So motivation gets you started, but I think it's the habits that you keep you going. So my view is that excellence is always habit. If you get habituated to improving your business every single day, every single hour, every single month, every single year, you will find after a few months, a few years, that you have a very superlative business which nobody can take away from you and nobody can compete with you. But if that motivation is you let it down and get into negative habits, then I think you'll only bring your own downfall. So I don't think so that's a great way to build a business. Next slide, please. So my view is very simple, that in my view, and I change, and I will thank Nikhil for this because this are his words, but he put it beautifully. The change we seek is from being an individual financial advisor to become an institutional financial advisor, which lives beyond us, and the assets that you create, leave a legacy, and the customers that are created, become really indebted to you for life. And just to share with you, I was in Hyderabad recently, and I met a gentleman who was 80 years old, and he said, I became an agent of UTI in 1964. My son became an agent of UTI in 1987, and my grandson has become an agent of UTI just about 3 years back. So think about it, if you could go and your grandchildren say that, look, I adopted this profession because my dad started this or my grandfather started this, and today perhaps we are the largest in our locality, in our area, in the city, or in the country, and we thank our seniors who enabled us to do that. So that's it from my side. Thank you very much for a patient hearing here.
Suraj, just a moment. Wait. Can I request Nikhil Mehta to come on the dais? Thank you, Suraj. And as promised, one down, Dravid, your most dependable batsman, a step-by-step process to be the change which you want to see. Suraj, it was wonderful. Can I hear it for Suraj once again? Thank you, sir. A clear roadmap as to how to drive the change. And he was very clear, ambition, take a long-term view of your business, build annual plans, diversify your business, acquiring new customers all the time. Build your organization, leveraging technology to serve customers better, and from an individual financial advisor to an institutional financial advisor. That was the best thing which anybody could have said that. Thank you, sir. It was wonderful. Thank you.
We now welcome Mr. Vineet Bhatnagar, the country head and managing director of Phillip Capital India Private Limited. With over 20 years of experience in the financial markets, Mr. Bhatnagar possesses a great understanding of derivatives and commodities markets. He is a PGDM from the Indian Institute of Management, Ahmedabad, and has been associated with reputed organizations like Prime Securities and HSBC. Mr. Bhatnagar will now take us through the global asset allocation dynamics. And can I request you, sir, after the presentation to just stay on the stage for a while? Thanks.
Good morning. Thank you very much. I guess just carrying forward from what the previous two speakers shared this morning with us, I just want to start adding a new element of the theme of this conference, which is I Change. Mr. Puri, in his opening address, pointed out that in order to have a sustainable long-term relevance as an advisor, it is important to start looking at the both the attitude and the aptitude as far as an IFA is concerned. And one of the elements in my view that one should look at to create that sustainability and advantage is to broaden your product array or to add to what you have been doing thus far. I guess when we talk about what we have as financial advisors offered as an advice or as a service to our customers, we have been very much localized in our approach, in our market understanding. Today's topic that I am going to talk about is actually going to talk about global markets, and therefore the relevance of a global asset allocation as far as your clients are concerned going forward. India as a marketplace is still nascent in the sense that we have all started looking at the market and the market products only for the last 25, 30 years. And therefore, it was only expected that the dynamics of the markets, whether it is the equities market, and then came the derivatives markets, and then came commodities markets, futures came, options came. We have started looking at structured products. We have started looking at private equity as an investment opportunity for some of our HNIs. But the landscape has been very much local. A lot of it has been therefore focused only on India as the domestic market. Now, while we have added an element of diversification by looking at the different asset classes, I think one element that we have not been able to diversify out of is the geography, which is India. And therefore, today what we are going to talk about is the possibility and the feasibility of looking beyond the local boundaries to see whether there are opportunities and whether there is a merit in now talking about diversifying and allocating some of your clients' assets in international markets, whether it is available, whether it is permissible, and what could be the feasible way to approach it. So I start my discussion with a relevant saying from Benjamin Graham. He said that in the short run, the market is just a voting machine, and it is only in the long run that you should start looking at it as a weighing machine. What does it actually mean? What it actually means in my own interpretation is the following. So is the market going to go up or down? If you take a view this morning, tomorrow morning, next Monday or Tuesday, it is going to be more of a popularity contest. It is going to be more of a tug of war between the traders and investors and the bulls and the bears. It could go up, it could come down, and perhaps the odds are evenly placed whether you are going to come out as a winner or a loser. But it is only in the longer run when you start asking the questions about, will I make money as a long-term investor in any market, perhaps more pertinently in the equities market, do you start looking at, is there a reason for, say, for example, Indian corporates to make money over a longer period of time? Is the business cycle and the economics favoring towards earnings growth over the next 10 years? And that is when you start weighing the merits of investing in any particular market or in a particular asset class. And that's exactly, in my view, what Benjamin Graham said, and there is a lesson and a relevance for it even today. So this is the topic for me today, global asset allocation dynamics. I will start from the first point of what are the fundamentals of asset allocation. So one of the reasons why an advisor or an IFA should actually look at doing asset allocation is because it should meet the investment needs of your client or of your investor. Your investor has a requirement as to how the money should be allocated. By the way, by not doing anything at all, you have allocated your asset, whether it is a cash lying in the savings account or FDs lying in the bank account. There is a de facto allocation even by inaction. And therefore, in order for an IFA to understand what the needs of a customer is, you need to understand various aspects of your customer's requirement, whether it is his age, whether it is his future planning, whether it is the risk awareness, whether it is his income expectation on a monthly basis or a capital appreciation over a 3-year period. All of that combined will give you the matrix which you will work with to understand what the allocation need for a particular customer for you of yours is. One of the reasons or one of the fundamentals of asset allocation should be that it should result in a diversification of the portfolio for a customer for two simple outcomes. One, optimizing the returns. I have aggressively written as maximizing the returns, but obviously on the other side, minimizing the risk. So it is this risk-return theoretical concept that we all so well understand, or so many times that we have read, which needs to be at the front of our minds all the time, right? And therefore, any product seemingly risk-free should still be investigated quite closely to really understand whether there are any inherent risks that we might have not understood. One of the prime examples is a Badla type of 14% NSCL product that we have all seen in the last 18 months blowing up in our faces. And therefore, as an IFA or as an advisor, it was important for us to understand whether the underlying transaction that was happening in physical commodities, was there enough that was available to us information to see the availability or the presence of that commodity in the warehouses, which we all assumed was available. And the outcome is that an apparent income kind of product has come across as the most risky product because there was no collaterals. The third element of looking at a global asset allocation or an asset allocation exercise is to see whether there are asset classes that are available for your clients. Right? So either it could be because of regulation or it could be because of the ticket size. So by regulation, I cannot participate as a resident Indian into foreign exchange markets abroad. And because of the ticket size, nobody is interested in my 10 lakh rupees to go into a private equity as an opportunity or as an asset class. The final element about the asset allocation exercise is to have a view about the market, right? Each one of you in this room must be and should be having a view of the markets in general, right? Whether it is the international markets, whether it is the local markets, what are the macroeconomic factors that you have taken into account to come up with a possible asset allocation? 2 years ago, your view about high inflation in the country perhaps moved you and your customers towards debt-related products, whether they were the FMPs or the debt mutual funds. Today, you are taking a view that there is a revival in the economy at the ground level. There is a clear chance of headline inflation not running away beyond a particular number. There is a great expectation of the central bank governor coming up with a softer interest rate regime, and therefore the corporate earnings can grow, would grow,